The Commodity Channel Index is sometimes shortened to CCI. It's an indicator that can be applied to other charts besides commodities, such as charts of stocks and currencies. The CCI is based on the difference between price and a moving average that is usually set to a length of 20 by default. As a result, when price is over the moving average, CCI will be above 0. Price closing under the moving average is displayed with the CCI below 0. The channel is defined by a range from -100 to +100, where the majority of market movement should theoretically take place. Going higher than this range can indicate overbought conditions. Going lower than this range can indicate oversold conditions. In the following lesson, we will look at various uses of the CCI, along with preferred conditions for its application in cases where it fails and/or has limitations. A wide range of real chart examples will be covered from various time ranges. So no matter when you watch this or which particular charts you choose to apply the CCI on, information presented in this series can be of use to you. During a stable downtrend, there can still be areas where the chart is oversold. A common indication will be shown with the CCI at or below -100, followed by a crossback into at least the -100 to 0 range. At the same time, there should be reversal characteristics with price, leading to at least a minor retracement. On the other side, CCI goes over +100 and reverses back down along with price relatively quickly to indicate overbought conditions. For more context, the range concentrating around the 1940 level has been a contentious area in the recent past. So it's no surprise, even with the sharp rebound of price in the short term, there's been an almost instant bearish reaction upon contact with this area that naturally coincides with a sharp peak of the CCI near +100. Also, the price range around 1590 marks the lower boundary of a likely double top range. From a bearish perspective, after price closes under this boundary, it would be preferable to see CCI values remain around or below -100, while price continues to fall, in order to provide not only the strong indication of a double top reversal, but also signs of a sustainable downtrend and a bearish continuation. At some points, higher bullish retracements are able to take the CCI up towards 0. As long as values quickly drop back under 0 at the same time price continues to fall, there is no major opposition to the downtrend. Here's a similar situation, but with weaker bullish sentiment, due to CCI remaining relatively close to -100. So in this case, the chart is experiencing oversold conditions delaying the downtrend, which eventually resumes in the near future. Later, there's a similar occurrence with the CCI, except this time price also has a similar shape to its movement, leading to a much more defined indication of oversold conditions, resulting to a more significant bullish reversal, which is strong to begin with but eventually slows down on a shallower incline, leading to the CCI being stuck near +100 for a relatively extended period. No sharp peaks and reversals back under +100. So it's not a strong indication of immediate overbought conditions, compared to this area, which is closer to those sharper peaks we've seen before. Then with price recently taking a similar route with the addition of several bearish candles and quick confirmation of them. A relatively rapid reversal like this is to be expected when overbought conditions are more clear, and other factors in the shorter and longer term context support at least a minor to moderate downswing. In terms of regular retracements within this downtrend of 2 fib levels or less, it can be normal to see peaks just over 100 for the CCI. Slightly deeper retracements can see a more defined peak over +100, similar to what's seen with more impactful reversals. Now, with a large spike up like this, a bullish perspective for a strong uptrend continuation would aim to have CCI values remain over +100, as price makes a normal minor bearish retracement, then continues sharply higher. There's still potential for the uptrend to persist as long as CCI values remain over 0. These will be, of course, weaker conditions from neutral to bullish, but it will still be a bullish advantage displayed by the indicator nonetheless. That is, of course, until a sharp drop below 0, followed by consecutive closes lower with price. Then, of course, the drop can eventually weaken, but there's still a distinct bearish advantage, especially with CCI values remaining closer to values at or below -100. Now, with price and the CCI beginning to rise back up, it's similar to the previous example when we looked at oversold conditions and the bullish reversal potential. In this situation, it would be preferable from a bullish perspective to have further uptrend development accompanied by CCI values at or above +100 to indicate a strong uptrend, and to have values remain at least within the 0 to +100 range for the maintenance of at least a slight neutral to bullish advantage. Then, just like before, there's the decisive close under the moving average, resulting in negative values for the CCI. This is a moderately strong drop since values don't sustain under -100 for long. though values still do mainly stay under zero during this shallower drop with lower, yet still consistent red volume. Another drastic spike up redirects bullish attention to see if CCI values will remain over plus 100 as price increases. This does not hold for long, so there's naturally no major uptrend continuation. And while the chart begins to drop even more, CCI values begin to enter the 0 to negative 100 range for a more distinct bearish advantage, just like we've seen with the initial phases of previous downtrends. Usually the CCI will go up and down with the chart, but like with other indicators, there can be divergences. It happens to a lesser degree here for a brief period. Then like normal, the CCI and the chart begin to have the same approximate movements again. When divergences occur, they can indicate a trend can begin to slow down or even reverse. Now this is not strictly a divergence, but it may first appear the CCI and the chart are not closely approximating each other's movements. This is because the first major part of the trend that goes over the moving average will initially create more distance above the moving average, resulting in a higher CCI value compared to this similar yet later portion of the trend, which is of course higher than the first portion. But by this time, the CCI values are slightly lower as the naturally lagging indicator of the moving average begins to catch up and close the distance between the line of the moving average and the closes of these more recent candles. And since the CCI is based on how far these candles are closing from the moving average, the values will be slightly lower than before. Coming up here is a more noticeable divergence where CCI remains relatively flat, while the chart continues to close significantly higher. This is to be expected as we've seen in previous examples. A strong uptrend will see the chart continue to rise on a steeper angle, usually as long as CCI values can sustain at or above 100. Since this divergence between the inclined movement on the chart and the relatively flat CCI hovering around 100 lasts for an extended time, a reversal becomes more likely. And movement of the chart and the CCI will generally return to being quite similar. Though it should be noted, an immediate reversal isn't always guaranteed, even if there is such a noticeable divergence like this. Sometimes the trend can flatten for an extended time before reversing, or just to retrace lightly before continuing higher. Starting off, there's a relatively minor divergence, which leads to a prolonged flattening of the trend instead of an immediate reversal. Now, with some decisive closes lower and the usual drop of the CCI below the 0 to minus 100 range, it can be said there is a strong start to a new downtrend. For additional detail, we can also add the Arun indicator, which has already been covered in a separate lesson. Here, a bearish perspective for a sustained downtrend would favor Arun lower remaining at the higher ranges of the Arun indicator, along with the standard characteristics of the CCI remaining close to or below minus 100 during the stronger portions of a major downtrend. And for additional bearish advantage, it would also be preferable to see a Arun upper at the 30 to 0 range. But once these conditions begin to fade, there's less favor for the downtrend, and a reversal backup becomes more likely. Now, if a Fibonacci retracement is applied, the fading of bearish conditions displayed by the indicators also happen to be around the site of a major continuation taking place after this deeper downward retracement began to end. In terms of breaking over 25 decisively, it would be best to see price keep closing higher, while CCI values remain close to 100 or higher, while at the same time Arun upper remains at its upper range and Arun lower remains at its lower range. And again, once these values are not met, less favorable conditions for the uptrend emerge. And a bearish reversal isn't guaranteed, but it becomes more likely. Here it is the distinct shift back to a bearish advantage, which isn't sustained for long. Instead, some bearish conditions emerge, but they're relatively weak as well. If we take a look with the Fibonacci retracement, we can extend it higher now, but this large fib is too wide and imprecise for these more recent and volatile movements. So we bring it into this closer range based on the last major upswing. These recent transitions are revealed to have taken place at a deeper retracement level, which was also at the site of a double bottom formation, which provides extra bullish context to clearly explain why there was a relatively large and rapid upswing at this area that was also confirmed by the indicators showing strong bullish conditions during that brief period. For more on indicators as well as Fibonacci methods, follow Ascencore. Thanks for watching and have a nice day.